This is p14-14, and it's wanting us to compare the debtor and creditor entries for how we deal with a troubled debt restructuring. We have Crocker Corporation, which owes Yeager Corporation a 10-year 10% note in the amount of $330,000. Let's see if we can get that a little bit bigger. $330,000 plus $33,000 of accrued interest. So the carrying value right now is $363,000. The note is due today, December 31, 2017. Because Crocker Corporation is in financial trouble, Yeager agrees to forgive the accrued interest, the $30,000, the accrued interest, which is the $33,000 of the principal, and to extend the maturity to December 31, 2020. Interest at 10% of revised principal will continue to be due on December 31st each year. So the instructions here are to compute the new effective interest rate for Crocker Corporation following the restructure. And find the interest rate that establishes approximately $363,000 as the present value of the total future cash flows. So let's take a look at this. If we have, and this is going to be, we're going to have payments here, here, and here, and on this is 12/31/17. 18, 19, 20, and then the maturity date is going to be on December 31st, 2020. So what's going to be paid here is there's going to be 10% interest on $300,000. So we had $330,000, but we're going to take away 30 of that, and we don't have to pay the 33. So we have 10% interest that's going to be $30K here, 30 here, thousands, and 30 here. Plus, we're going to pay 300, and we being Crocker Corporation is going to pay $300K at December 31st, 2017. It's really important that you do one of these timelines. I can't emphasize this too much. Okay? So it says now compute the effective interest rate that establishes this $363,000 here as the present value of this stream of $30,000 payments, interest payments, and a $300,000 out there. And they give you these present value factors up here. And so one way to do this is to take those, and let's start with 2.5%. If we start at 2.5%, the factor for the principal piece of one, because there's one payment out there, at 2.5%, that's this one here, is going to be 0.92859, where I is equal to 2.5 and n is equal to 3. That gives us 0.92859 times 300,000, and that's going to be equal to 278,577. Now, to deal with the 30,000 payments, we're going to have a piece of A, and that's how I do the notation. Piece of 1 is one future amount, and piece of A is the annuity, 3 equal payments of 30,000, where I is equal to 2.5 and n is equal to 3. and that's going to be the 2.85602. Let's see if I can get that. $85602 times 30,000, and when I do that, I come up with 85,681 for a total value of 364,258. Well, that's too high, because what we're looking for is something at the 363,000 level. So the payments remain fixed, and so what we're looking for, this is essentially the principal portion. If we want the principal portion to decrease, well, what we need to do is bring that down, and that we do that by increasing the interest rate. So let's try 2.75%. P sub 1, I is equal to 2.75, n is equal to 3, and that factor is going to come up from here, 0.92184 times 300,000. And when I do that, I come up with 276,552. And when we do the annuity part for the interest payments, I is equal to 2.75, n is equal to 3. That factor is going to be 2.84226 times the 30,000 payment, and when I multiply that out, I get 85,268, and the total value there is 361,820. Remember, our target here is 363,000, so maybe we should try just a little bit. We'll go here at this level, which is the 2.625, 2 5/8%. Because we're 363, it falls between these numbers, and so we're looking for an interest rate that's between those, and the one we have is 2 5/8, or 2.625%. P sub 1, I equals 2.625, n is equal to 3, and that factor is going to be 0.92521, 300,000, and when I multiply that out, I get 277,563, and P sub A, I equals 2.625, n is equal to 3, 2.84913, that's from up here, times the 30,000 payment, and when I do that, I get 85,474. Add them up, 363,037. And that is what we're going to use as our interest rate. And this is for A. Okay. Next up, it says, prepare a schedule of debt reduction and interest expense for the years 2017 through to 2020. Okay, so we're going to use this 2.625. And I'm going to go back to blue. We're going to have this date, paid, interest, and premium change and carrying value. December 31st, 17, we're going to pay $30,000. The interest part of that is going to be the $363. You probably wonder, well, where does that $363 come from? Well, that's what we had for a carrying value. And we're going to leave that in there. Our 363 is our carrying value that we start out with. And then we calculate the interest on that at 2.625. So we're going to take 0.02625 times 300,000. And when I do that, I come up with 95.29. That's interest expense. We're going to reduce the carrying value for the difference between 30,000 and 95.29, or 20,471. And that's going to be a reduction in the premium or carrying value, if you will, 342,529. We call it a premium here, and I'll explain why in just a little bit. In the next year, 18, there's a 30,000 payment. We're going to take, I'm sorry, that was calculated. Come on in. So I need to erase this because I've applied the 2.625 is based on the 363 carrying value. So we need to change this. And that's going to be, we'll put that in there at 363 is the amount. Okay? And that gets the 95.29. Then when we take the next year, we're going to take the I'll do that also in black, 0.02625 times the carrying value, 342,529. Now, that's a little bit lower of a base, but the interest rate remains the same, so that our interest expense for the second year is $89.91, and the reduction in the carrying value, $21,009, and this becomes $321,520. In year 19, we have another $30,000. Our interest based upon the carrying value here, and what I did was, I want this to end up at 300,000 because that's what we have to pay, and so I basically force this to be 21,520 and back into the interest expense, which becomes $84.80. And there was not a big difference, but that's how I got the $84.80. Okay, that is the answer to B. If we look up here, C, it says compute the gain or loss for Jaeger and prepare a schedule of receivable reduction. So Jaeger is the lender here, and for Jaeger, in C, gain or loss to Jaeger, so the carrying value of what they had on their books. They had a note receivable for $330,000 plus the interest receivable of $33,000 equals $363,000. Now, their present value on this is going to be a present value of the $300,000. Present value of restructured payments at 10%. And they're not going to change that 10%. They're not going to work with a 2.625. They're going to say, well, our cost of capital still is 10%. So the present value of the $300,000, P sub 1, I is equal to 10, N is equal to 3, is going to be 0.75132 times 300,000. And that's going to be, see if I can figure out how to do that. That moves the whole thing. That's going to be equal to 225,396. And the present value of the interest payments. So we've got three $30,000 payments. Still, I is 10, N is equal to 3. The factor for that is 2.48685. 30,000, and I come up with 74,605, which rounded together, since it's a 10% note. And there's some rounding here, but it comes out to 300,000. And that makes sense because we're issuing it at par, right? We're issuing this 10% note at par, that is at 300,000. The present value 300,000 and the 63,000 loss. Restructuring. Okay, so that's C. D says prepare all the necessary journal entries on the books of Crocker. They're the borrower for 2017, 18, and 19. And in D, let's do D in blue, just for grins. In D, we're going to have, I forgot to do the interest payment schedule. The interest payment schedule in that last one, let me put that in there for you. This is still part of C. Interest payment schedule. This is from the lender's point of view. Once we've written it down from 360 to 300,000, our carrying value is 300,000. At the end of 2018, we're going to receive 30,000 of interest in cash, and it's all interest revenue. There's no change, and this becomes 300,000. 19, have another 30,000 of interest revenue, no change in the carrying value, and we still have 30,000. In 20, another 30,000 of interest, no carrying value, no change in the carrying value, 300,000, and I'll write that out for you. Is still the carrying value. And then also at 20, we're going to get 300,000 principal repayment. That's going to be a reduction in the carrying value, 300,000, and this becomes 0. And there's our interest payment schedule. In D, we're going to do Jaeger, journal entries for Jaeger. And Jaeger is the lender. I'm sorry, this is for Crocker. I'll get this straight yet. For Crocker, D, Crocker, borrower, journal entries. Remember, when we did this up here, from Crocker's point of view, does Crocker recognize a gain? Old carrying value was the 330. Sorry, I will get this straightened out here. 330 plus the interest accrued, which was 33. So the amount of debt that we had on our books was 363. And then the new debt we're going to have to pay these payments right here. And that all adds up to 390,000. And as long as the new debt total payments are greater than the old carrying value, therefore no gain recognized. Okay? Now, if our total payments going forward are less than our carrying value on our debt, yeah, we're going to recognize a gain, but that's not what's happening here. Okay? So now, the first thing what we're going to do is we're going to roll the interest payable over to the debt. In the journal entry, this is at December, this is in the journal entry. December 31, 2017. We owed $33,000. This is a debit. And we're reducing that and increasing the note payable because it was what we call rolled into the new debt. And then we're going to have interest expense and interest payable for each year, interest paid for each year. We'll do this for December 31st. And we'll have 2018, 2019. We'll have debits and credits. Debit and credit. We'll have interest expense. And this is coming off of this right here. The first year in this payment, this is really 18. 17 was the 363, December 31st, 2017. This is 19, and this is 20. In fact, I can do this better, Jeff. it look nice. And then we'll do it like this. 2017, 2018, 2019, and 2020. So this 2017 goes over to the 363. Okay, so in the first year, we're going to have interest expense. 2018, we're going to have interest expense of $95.29. We'll have cash paid, $30,000, and note payable is going to be debited for $20,471. That's a 1. In the next year, we're going to have $89.91 as the interest expense. $30,000 cash outlay, that doesn't change, and we get $21,009 as our journal entry for recording an interest expense in 2019, which was the requirement there. All right, now let's take a look at Yeager's journal entries. Yeager, who is the lender, journal entries. The first thing on December 31st, 2017, remember that Yeager lost $63,000 on this because they had something that had a carrying value of $363, and now they're going to have something that's actually worth $300,000. And so we're going to have allowance for doubtful accounts. You could also debit loss, but normally I think the better thing is a debit to allowance, because they do set these up. That's the whole purpose of the bad debt expense and the allowance. We're going to debit that for $63,000, and we'll credit notes receivable. That's what it was an asset for $63,000 to write off a portion of the note receivable in restructuring. The next thing we're going to do is at the end of 2018 and 2019, we're going to have December 31st each year. We'll have a credit to cash and a debit, that's a debit to cash and a credit to interest revenue because we're collecting it. And each year that's going to be for $30,000 to collect interest. So there you have it.